This episode of the Renewable Energy Smart Pod is brought to you by ExxonMobil. The world needs ways to reduce carbon emissions. ExxonMobil is working on solutions in its own operations, like carbon capture and clean energy from hydrogen, that could also help other businesses, like manufacturing, commercial transportation, and power generation, helping deliver heavy industry with low emissions. Find out more at exxonmobil.com or click on the link in the show notes.
What's up, everyone, and welcome to the Renewable Energy Smart Pod. I'm your host, Sean McMahon, and if you'll pardon the pun, I'm going to say we have a very taxing episode in store for you today. Climate Week is about to kick off in New York, so I've invited Lauren Collins and Michael Joyce, a pair of partners from the law firm of Vinson & Elkins, to join me to talk about what to expect from that event, what kinds of news and announcements they will be keeping an eye on, and how the overall conversation about Climate Week and climate coverage in general has evolved over the years. We are also going to mark the 1-year anniversary of the Inflation Reduction Act with a deep dive from Lauren and Michael on the impact that ginormous piece of legislation has had on the renewables sector. We'll discuss how the IRA will continue to reshape the energy landscape and what to look for as policy guidance from U.S. government agencies continues to be released. We'll also spend a few minutes talking about headwinds that might slow the role of the IRA and how developers and other market participants are trying to protect themselves from various sources of uncertainty. Lauren has been on this show before, and this is Michael's first visit, and they do a great job of teaming up to share a ton of expert-level insights. But before we hear from that dynamic duo, just a quick plug for another show that is part of the Smart Brief Podcast Network, the Sustainability Smart Pod. The Sustainability Smart Pod features experts from big-time companies who are leading the effort to tackle sustainability challenges on a global scale. I'm talking about companies like Patagonia, Panasonic, AT&T, Wendy's, Marriott, Deloitte, American Airlines, and more. If you're serious about sustainability, the Sustainability Smart Pod is for you. You can find it on all the major podcast platforms, or just click on the link in today's show notes. Right now, let's get ready for Climate Week and get things rolling with Lauren Collins and Michael Joyce from Vinson & Elkins. Hello, everyone, and thank you for joining me today. My guests are a pair of partners from the law firm of Vinson & Elkins. We've got Lauren Collins and Mike Joyce. Lauren, how are you doing today?
Doing well. Good to see you and talk to you again.
Yeah, Lauren's been on the show before, but Mike, this is your first time. How are you doing today?
Thanks for having me, Sean. Doing well.
Great. Well, there's a lot of things going on in the renewable space right now. Obviously, Climate Week is coming up next week. So I'd like to talk a little bit about that, and then maybe we'll get to some other things going on, the anniversary of the Inflation Reduction Act and things like that. It seems like when we read the news these days, every week is Climate Week, quite frankly, but this annual event pops up. So what have you noticed in terms of the discussion around climate? Is there more action-centric conversations going on, or are we kind of still in the debate about policy and things like that? Mike, you want to kick us off?
Yeah, happy to, Sean. I would certainly say we are in a period of action, and we see that both in connection with the passage of the legislation that we'll come to later, but more importantly in the transition from what had been referred to as ESG and the suggestion that these concerns were starting to change things and translate into the boardroom and to where these companies invested dollars. And for years, that was a lot of lip service. The term greenwashing was thrown around. And today, that is markedly different. We see new entrants in the market. We see folks that are focused and driven by their shareholders to invest in climate-focused policies. We see private equity funds raising new funds with lower hurdle rates to focus on renewable investment that don't necessarily have the same returns that some of their traditional target sectors had. So, we heard about it for years, call it a decade. In the last 18 months to 2 years, we've seen the investment skyrocket, and the data backs that up. So it really is the time of action. Is it going to be enough and soon enough? That's harder to tell. To your point, you read in the news about the coverage of climate action, but that's not just in terms of investments people are making. That's in terms of natural disasters, whether it be the recent floods and otherwise. So the question remains as to, can we get in front of the tide? But the action is clearly kicking off for reasons both principled as well as economic, in terms of the incentives being there for investors to put their dollars behind these sort of initiatives.
And as Michael mentions, we've been seeing this accelerate over the last 18 months, 2 years. But with IRA, everything was really supercharged. And just anecdotally, the end of last year, beginning of this year, a lot of our work, or a lot of the effort I was spending, was more policy debate and more education. And now in the past 6 months, we've seen that translate to real deal flow. And much more of my time is now spent on term sheets and transactions and getting folks up to speed. And we're seeing that, just like as mentioned, in the news. There seems to be a new piece every day about the climate change and energy transition and manufacturing facilities opening in the US. So we're seeing everything from the IRA really start to come to pass, which is exciting.
Yeah, it definitely sounds like things are, turning the corner towards action. So again, looking at Climate Week next week, for people who work in this industry, in the renewable space, like the two of you, are there any ideas or proposals being put out there? Obviously, a lot of consumer brands kind of like to hype their efforts during next week and things like that. But is there any specific area around Climate Week, whether it's policy or finance or transportation or even energy itself? What are you paying close attention to?
I think there's all of the ones you mentioned, honestly, but there's a few in particular around Climate Week that I think are exciting. Environmental justice is one of the topics that we'll be focused on, and that comes up in the IRA as well, where we see additional benefits for low-income communities and energy communities, and we also see new labor requirements and prevailing wages needing to be paid, and apprenticeship programs all opening up. So I think that's a good focus. That's something we'll see talked about a lot in the next week and beyond, and just reflects kind of an overall policy objective of making sure that we're all pushing for climate change, but we're doing so in a way that's really equitable and not leaving folks behind. And then transportation too, as you mentioned, Sean, that's an area where we'll see a lot of focus in the next week, but also an area where we're seeing lots of deal work, right? EVs, EV charging, greening fleets. Those are exciting areas where we're seeing an uptick in interest on the investor side.
Well, I'd add that the narrative's changed. I mean, the Brookfield CEO was speaking today, and whereas transition and energy transition might have been a part of his speech, it was largely focused on energy transition and renewable energy. So it's not an afterthought or a side note. It's the main focus and thrust of some of these businesses. There is the way that those of us who work in this space think of it, and the way that the general public thinks of it. And there's still quite a divide there. I mean, I was with family over the weekend, and they were talking about the California initiative on EVs specifically, and how that affects consumers, and what are we really doing? Is it kind of high-minded idealism, or is it something that's really necessary to move the dial? You see a lot of the same protests from truckers around the cost of the long-haul trucking changes that will be imposed under that same ordinance. So a way to say that there's still work to be done in having folks appreciate at the public level why these policies are being passed, and that they are more than lip service or just some government agenda, that it really does translate to trying to get in front of the other half of the newspaper, the natural disasters, the uptick in climate, the death from heat, the things that are really strong with it, that make us have a week like Climate Week. The other point I note is it's not a week anymore. Like, this is life. I know it translates as a nice soundbite, but the truth is we're all struggling with the impact of this. Try to take a vacation this year. I'm sure you've noticed that your favorite spot was different, had less water, was hotter, whatever it is. It's really hard to deny the importance of focusing not just on individual transactions, the stuff that Lauren and I do every day, but the broader initiatives that we need to publicly get behind to help support the changes that will hopefully help protect us and catch up against the trend in climate that has been going the wrong way the last several years, if not decades.
And that's an area that you hit on, Michael, that folks can debate whether these are the right policies, or whether we should be focusing on EVs or solar energy, or whatever the topic du jour is. But now we're seeing these projects be financeable. We're seeing them develop their own marketplace. They're creating jobs. They're creating U.S. manufacturing. So the conversation doesn't need to just be about ESG or greenwashing. It can be about these are actually really valuable projects and investments that are better for the economy than the status quo. And that's a shift that I've seen over the past few years. And the IRA really helped with that quite a bit.
Yeah, now, Mike, you mentioned speech by the executives from Brookfield, and Lauren, your comments on conversations about finance. So that kind of leads to my next question. Like, how have the conversations when you're, you guys work on deals, and I'm not asking you to share any specific deal things, but trends, questions you're getting from financiers or interest they're showing in how and where to invest in renewables. Have those trends changed at all?
They certainly have, because we can have all the ideals we want and all the reasons to change, and until the money's behind it, it really isn't much more than lip service and press, right? So I was sitting with the folks at Protect Our Winters a couple of years ago, and they were talking about some of their policy initiatives. I said, look, I hear a lot of it in terms of you won't support people that support fossil fuels. But if you think that if you're going to be able to drive change in the agenda without having a dialogue with those people, or more importantly, where their money comes from, you're kidding yourself, because there's still an economy. The investment dollars follow opportunity. Yes, there are shareholders who are younger, have different views on the importance of climate change, that are kind of having more influential voices in those boardrooms or in those private equity funds. But the business is still to make a buck, as crass as that sounds. And until you can align the economic incentive with the policy agenda, you're going to have a tough time advancing that agenda. And what we've seen with the IRA and some of the other initiatives is having the government step in and do what many of us believe the role of government is, which is to fill the gap and help align those economic incentives with the policy agenda. And Lauren and I see that every day in terms of new market entrants, right? The renewable investors have traditionally been a small club of banks and insurance companies and a couple of targeted private equity folks that were focused on these sort of initiatives because of opportunity and some of the things they saw. In the last 2 years, everyone's come off the sidelines. Lauren and I have been dealing a lot with corporates investing through transferability, and that really kind of, again, putting those dollars behind the agenda in terms of additionality and adding projects that are going to lead to a better footprint versus just some greenwashing. I bought some RECs, right? So we see it in terms of where the dollars are being spent, who's spending the dollars, how the funds are being raised with the targeted focus towards renewables. So the action and the investment is catching up with the agenda, but there has been gap filling to get there in terms of what the government's done as well.
Sean, I think you and I talked about this a year ago, but IRA enacted transferability, which allows you to buy a credit from one of these renewable or clean energy projects. And you're going to buy it for less than it's worth. So you could buy a dollar credit for 95 cents. You'd be crazy not to, right? And so the IRA has turned each tax department into a profit center for these corporates. So that's why, as Michael highlights, we're seeing a lot of corporates come into the market and be able to invest in renewables and clean energy, not just because it sounds good or helps people sleep at night, but because they actually make money by doing so. And I think we're going to see even more uptick as we see more public company reporting, because there are plenty of companies that are on board and jumped on the bandwagon early and often and are doing these deals already. But there's others that have been sitting on the sideline. And the second that public company reporting starts coming out, those companies that haven't done it yet are going to be getting questions from shareholders as to why not, because it's almost irrational not to.
Yeah, Lauren, we didn't just talk about that last year. You actually highlighted that as something that was going to be huge, which was a bold prediction I think you might have made that was right. So kudos to you. And Mike, your point about the fossil fuel industry, having a dialogue with them, I couldn't agree with that more. I feel like whether it's the dollars, whether it's the know-how and the technology or things like that, there's going to be a role to play there for sure. So we've already talked a lot about the IRA, and I definitely want to do a deep dive on that. But before we get there, anything else about Climate Week that you're keeping your eye on, or any individuals that you're going to be curious to hear what they have to say?
Like, to Lauren's point, I'm interested to see where companies come out in terms of some of their directed statements around what they're doing. I mean, we have long had a dialogue around the ESG side of the practice, which is kind of the capital markets boardroom side in terms of what shareholders were focused on and how they manage it. And there was this chasm of, okay, well, I'm going to be carbon neutral by X date without any real plan to get there. You know, the way that the securities laws have shifted, there needs to be a plan now. It is Climate Week. It's the time to talk about it. So we expect companies to seize on those opportunities. I'm interested to hear what they have to say.
Yeah, completely agree. That's probably what I'm most interested in, is just seeing all of the announcements come out over the next week of things that folks have been working on but have waited till Climate Week to announce. I mean, just yesterday, Trina came out and announced that they're opening a facility here in the US. Amazon's buying a bunch of carbon capture credits from direct air capture that was announced earlier. So I think we'll just be seeing a lot of those kind of cool deals being announced and made public, which just increases momentum.
We'll be right back.
The world needs ways to reduce carbon emissions. ExxonMobil is working on solutions in its own operations, like carbon capture and clean energy from hydrogen, that could also help other businesses, like manufacturing, commercial transportation, and power generation, helping deliver heavy industry with low emissions. Find out more at exxonmobil.com or click on the link in the show notes.
And now back to my conversation with Lauren Collins and Michael Joyce from Vincent & Elkins. So now let's get into the IRA. You know, we recently marked the 1-year anniversary of its passage. And so let's look at things sector by sector, say solar, battery storage, wind, things like that. Which sectors do you think enjoyed the most momentum here in this first year that's already gone by? And which sectors do you think will continue that momentum in the year ahead?
Sean, I'd suggest that perhaps the two that we've seen have the most benefit are standalone storage, as previously being tied to the solar plus storage to get value from the credit. Now you have the standalone credit, which has really kicked those projects off. They're not without issue in terms of the revenue model. A lot of those are largely merchant or partially merchant, so they still have their own difficulties in investing, but having that 30% or potentially more credit helps fill some of that gap in the revenue model and lead to those projects kicking off. They're not renewable per se, but they are part of making renewable a more dependable resource in terms of storing from the wind and the solar that generates in the same localities. The other one that I'd focus on is hydrogen. We've been saying for the last year now that V&E was doing hydrogen before it was cool by virtue of all the ammonia work that the firm does. But that was gray hydrogen. And we talked about the rainbow of hydrogen, and we often do, but green was thought to be beyond reach or uneconomical. In the wake of the IRA, many gray development projects are now focused on green. We spent a lot of time looking at the GREET model to help companies calculate how they can kind of make that jump and access the higher credit. So hydrogen has been the other one that I've seen have the most focus. I will say that the smaller developers, particularly around solar, have had better access to capital markets by virtue of transferability. That's not to be underestimated. So there has been an uptick in solar. The folks that are maybe behind, and I don't mean that in a negative light, but carbon sequestration, carbon capture, those projects aren't well understood by traditional renewable investors. They now have even more opportunities in wind, solar, storage, things that they understand. So what we're expecting and hoping happens is some of the E&P folks and the folks that do understand those assets, otherwise have profits to shelter, get involved in that side of the equation, start moving those projects forward. Because in our view, the policy and the credits work, but it's going to take a different type of investor than the folks who have traditionally been investing in the sector to move those projects forward on a large scale.
I agree with all of that. The one I would add is just RNG and other clean fuels. And that has been a little bit of a surprise to me. I think, looking back over the past year, I didn't think it would play such a big part. Certainly, it's part of my day-to-day workflow, but there has been an incredible interest in RNG, dairy RNG, landfill gas. We're seeing lots of those deals, and the economics there are really hyped up from IRA. I think a lot of those projects were getting done anyway, because there's other credits and environmental attributes that are available. But you layer on now a new investment tax credit and these 45Z production tax credits, and those projects start to look really attractive. So we're seeing new investments, new tax equity deals, and M&A as well, all in the RNG space, which is very cool.
And that really just, Sean, another point on that. Again, talking about what the policy was intended to do, fill gaps in bankability, RNG is really a prime example because the other credits she refers to, specifically the RINs and the LCFS, are volatile credits. They're hard to bank, whereas a tax credit is a set dollar put against a return. And that really has helped bring additional investment capital into the space, kickstart some of those projects and getting moving at a much more accelerated pace.
So that's some of the momentum that the IRA is enjoying and might be expected to continue to enjoy. Any headwinds?
Headwinds wise, the guidance has not been equal in terms of the IRA was implementing legislation. We've been waiting on guidance. We've gotten some that was better than others. Transferability being an example of guidance that was largely helpful. Domestic content being an example of guidance that has been problematic in terms of folks. Again, it's accessing a bonus credit, so I'm not going to suggest that it's fatal, but in terms of motivating that onshoring and having people understand the credits that will be available from paying increased costs to purchase quote unquote domestic content versus how you calculate and prove out that it's domestic content. That's been one of the bigger challenges. The other one that I would highlight is just something we've touched on earlier, and that's the folks that traditionally have financed renewable now have more opportunity. So the same amount of dollars, same amount of profits, more opportunities, and we do need more folks to come off the bench. I agree with Lauren and hope that when earnings come out and people see the power of these credits on returns, that they get off the bench and take time to understand it. But it's still a constrained market, and that hopefully will continue to open up.
Yeah. The other item to mention that we've been getting a lot of questions on is Basel III. And I'll get out of my depth really quickly if I pretend to be a Basel III expert, but the basics there is that it can really limit tax equity investment and is something that might be spooking the market a little bit. And I think it kind of highlights that there is some inconsistency in Washington, where we have the IRA that sets out to accomplish very lofty goals, and then we have something like this regulation that comes out, the Basel III regs that are proposed. They are not final, but they would significantly limit the ability of tax equity investors to make these investments. And so there's, speaking of headwinds, that's exactly what it is. They're working against each other in terms of bringing more financing players into the market. So that we're hoping that gets corrected and that those proposed rules are not passed as they're proposed, but it's enough to kind of freak people out and slow them down a little bit.
Yeah, and just to unpack that for the audience, what the primary issue and what's in the proposed rules around Basel III is a 400% risk weighting charge on renewable investments compared to, say, 100% on low-income housing. The logic's a bit baffling, not just for the reasons that Lauren notes around, on one hand, the government's trying to incentivize these investments and make them more accessible. On the other hand, the bank regulatory side, they're saying they're exceptionally risky. It's the exceptionally risky that I struggle with when 85% of your return comes in the form of a government tax credit. Where's the risk? So it's baffling on many levels, and it's become an issue in deals in terms of negotiating outs and who's at fault, is there breakage, that sort of thing, the nitty gritty of what we do every day. But if passed in its current regulation, it would effectively shut down tax equity. And that's not an exaggeration in terms of there'd be very limited capacity, very limited deal flow. Transfers would still be accessible, but they don't have as much juice. And frankly, the transfer market on larger scale has relied on what we call a hybrid approach, where you have a traditional tax equity who takes down the bonus depreciation, some of the credits, and then transfers the rest out. All of that comes to a stop and takes the imprimatur off of the marketability of those transfer credits. So Lauren's exactly right. Probably the biggest challenge that we're facing day in and day out today is the cloud of Basel III.
It's all around the same theme that you started with, Michael, just the idea that we have the IRA. It has a lot in it, great benefits, will spur a bunch of investment. But we have the Fed slowing things down with Basel III. We have Treasury slowing things down with regulations being slow to come out. We have state and local permitting issues that slow down project development. And we have just overall capacity constraint. So, I like to be a bit of an optimist, but there are still some serious things that need to be overcome if the IRA is going to do what it actually set out to do.
Let me just jump in there. So, but considering the global nature of Basel III versus the domestic nature of the IRA, is the Fed not just trying to kind of have a balancing act there, or maybe it's the international players who won't mind seeing the U.S. slow down because they've been complaining about the subsidy nature of the IRA all along. So it's an international thing versus a domestic thing, and I can see why that would, where the rubber hits the road there, it could be difficult.
It's a very fair point, but it's hard to say, Sean, because frankly, the feedback we've been getting from some of the lobbying efforts has been that the government here has been relatively cold to date in engaging in the conversation. Maybe it's for the very reason that you note, in terms of it being a bit of a broker deal on an international level, but it's still hard for us to fathom in terms of being consistent with their own agenda.
Yeah, I'm not sure how present the U.S. was during some of those negotiations. Basel III has been in the pipeline for years. I've been covering the sausage making on that for a long, long time. Some of the parts of it definitely were determined before the Biden administration took office. Michael, you were talking about hydrogen and things like that. And one of the things I'm curious about, and just tell me if I'm wrong, because it might be. So I had a guest on the show from Louisiana, and, they got the hydrogen hubs kind of trying to set up all around the country. And, I thought of him when the Gulf deals kind of for offshore wind went not the right way. Any, I guess, I don't want to say threat to the hydrogen hubs, or just uncertainty around them based on what maybe a year ago seemed like it might be a viable power source that is either not going to happen, like that stuff, or siting issues or things like that?
What we've heard, and again, this is rumor at this point, is that because the other piece of the hub outside of co-location is using RECs to satisfy or to green up your brown power, right? Because you cannot produce on a 24-hour cycle with exclusively renewable energy, absent of very few co-located facilities. So the thinking was you'd be able to use renewable energy credits to green up your brown power, at least in the off times, if not in places where there wasn't large scale renewable. What we're hearing is that the guidance is not expected to come down with just you can buy RECs to make your energy green and move up in the GREET model. And that is a significant threat, because it's kind of like back where you were with storage plus solar. It doesn't make any damn sense from a grid stability perspective to put your battery next to a solar facility to get the ITC. It gets you the ITC, it doesn't help with grid stability. Similar thing, like where you can produce hydrogen effectively, move it, store it from, isn't necessarily where you can produce it green. So yes, there is an issue there. It's not just related to the offshore. It's probably the bigger issue is where we hear the guidance is going to come on the RECs not being fully eligible. It's a little opaque at this point, Lauren. I don't know if you've heard anything clearer. I've just heard that it's not going to go the way everyone's hoping.
I think that the hydrogen guidance that is pending is kind of hanging over everyone's head. And I think however it comes out, there will be folks that are really unhappy about it. There will be winners and losers depending on how you've developed your project. But the issues that Michael described, the idea that you can use market-based mechanisms to green your hydrogen, that there might be additionality or location or time matching requirements, those are all unknown. Maybe people closer to Treasury would be able to opine on where they think those will fall, but I certainly haven't an idea where Treasury is going to come out on these things. And they were supposed to come out with regs or some sort of guidance document this fall. Sounds like it's not going to be till December. Normally, I like to see guidance sooner than later, but I actually think that's a good thing, because this is a really hard issue and one that requires coordination between Treasury and DOE, and probably requires a fair bit of comment from taxpayers, which we know taxpayers are working on and have been engaged on. So I think it makes sense that they're taking their time to get it right, because again, how it comes out is going to have a major impact on whether projects qualify and whether they're economic or not. So there's a lot of pressure on Treasury to get it right.
So getting back to when you're interacting with, developers out there and they're trying to, close deals, we've talked about headwinds that the IRA has, and maybe a little bit of uncertainty around the tax credits because of Basel III. But are there any other questions or challenges that developers are facing? When they're kind of really getting close to signing those contracts.
One issue that I'm surprised every time it comes up, but it sure does come up a lot, is the potential for change in law. So IRA was passed, by a narrow margin, but it was passed and it's signed into law. And there is an ongoing concern that it might be repealed. And that is a somewhat reasonable concern given efforts in Washington to do just that. But But that is an area where I see developers being faced with challenges and almost having to backstop the change in law risk and ensure that to get a deal closed, if the law changes, they are kind of on the hook for it, which is a tough position for developers to be in. And as a general matter, they are getting squeezed from all sides. They have their investors that are trying to extract as much economics as they can, and then they have supply chain issues and contractors who kind of rightfully don't necessarily want to give up their own reps and warranties and indemnities. So in many ways, the developers are kind of left in the middle, in some circumstances, really holding the bag. And the market's kind of working all that out. And I don't know that it's finally settled, but that is something that I've seen.
Now, the one that I've seen is just the lack of talent. And I'm not saying we don't have a ton of talented people focused on this field. What I'm suggesting is you can't multiply production of something by 3x or more without having a talent issue, both in terms of building the facilities as well as managing the financing. So we see there's been a lot of movement within the sector on the financing side with people trading shops, kind of taking a better, higher paying job, and their old shop kind of filling that gap with less experienced folks. That might be frustrating on a deal for us financing types. It's potentially very problematic on the actual build side of things, whether it be manufacturing components or putting up wind farm towers. There has been, just a rush, a lot of movement in the sector, which has kind of depleted some of the strongholds in talent. And like the IPPs are still very strong, but they've lost a lot of talent in the last year. And it's hard to deny that we don't see that in our transactions and fear what it means for the actual projects themselves.
But was some of that not kind of structured in parts of the IRA?
Yeah, I mean, the IRA tried to get in front of that. And I'm not suggesting that Washington didn't do a good job of trying to forecast and address the issue, but it takes a while to train an apprentice. We safe harbored, or we're using begun construction for all the projects that are already started, and we already had negotiated contracts to get them built on time, on budget. So that the apprentices are just now starting, right? And again, 3x, 3x is a lot. If you look at like a teaching, like a school, and think of needing 3 times as many teachers to educate your kids, think about what that would take. It's the same sort of thing in energy generation and building the projects.
It's the folks on the ground where we have the apprentice programs that will hopefully increase the amount of workers that are available, but it's all stages through the life of the deal. It's the project managers, it's the financing parties, it's the lawyers. We need more of everyone. And, Michael and I have been doing this for a long time, but we need more of us to do this. So there's been kind of a ramp up process of just getting more people into the industry all along that chain.
Okay, well, you just mentioned that you and Michael have been doing this for quite a while, and I recognize that I'm talking to a couple of partners at a law firm. Are there any tax aspects that are continuing to kind of fly under the radar? I mean, Treasury is issuing new guidance, it seems like every other week, but is there any kind of nuggets you're waiting to see and that might end up proving pretty pivotal?
Yeah, one that came up recently that we were able to unpack and I was surprised by is the interaction of BEAT with some of these tax credits. And so it's an area that gets pretty nitty gritty into the tax code really quickly. But the idea being that even for direct pay of credits, if you're subject to BEAT, you really kind of lose a lot of the benefit.
Real quick, what's BEAT?
The base erosion anti-abuse tax. It was enacted a few years ago. It just serves as a minimum tax, basically. And again, it kind of came up over the past few weeks. And of course, once something comes up one time, it just comes up over and over again. So it's been very top of mind. But it's now something where anytime I'm talking to someone about doing direct pay, I have to stop them and say, hold on, are you subject to BEAT? Because that can change your calculus of whether you're going to do direct pay or transferability really quickly. And so I think that, if we're just talking about tax aspects, that's a good one. And just generally making sure that taxpayers are looking at their credits holistically. So, at the top of the show, we talked a lot about like everyone should be doing this, this is economically rational not to invest. That's definitely an overstatement, because depending on the overall tax capacity and attributes of a company, some credits may be more or less valuable. Transferability may be more valuable than direct pay, or just claiming the credit may be the best. So it's those kind of nuances, and making sure that anytime a taxpayer is looking to take advantage of these credits, they are working with their tax department, they're working with their tax counsel, and they're really understanding the overall impact of the credits that they're investing in and the benefits they hope to get.
And Lauren, I might suggest, as someone who's not a tax lawyer but runs across a lot of them, the one that I wasn't as familiar with and I've heard a lot is the at-risk limitations, and kind of appreciating how those impact private equity investors and the like, and may impact their ability to do transferability deals specifically, and some of the other structuring that we do.
Sure. And yeah, and I'll unpack that one a little bit. So for certain of the credits available through IRA, there are specific limitations for individuals and closely held corporations who have invested in those assets. And the transferability regs basically provide that those limitations continue to apply, or might even apply to greater extent, if you do a transfer transaction. And so that means for certain investors, like private equity funds that do have individuals or closely held corps in their structure, it can actually limit the amount of credit that is otherwise available and would be able to be transferred, or requires a whole lot of structuring and diligence in order to be certain that you get the credit that you think you're getting. And so, it's one of those things where, again, it sounds great, you get all these credits, but then you have to step back and say, wait a second, if I want that credit, I have to put in a bunch of corporate blockers. Otherwise, I have some of these limitations applying. And sometimes that just isn't worth it. So back to the same theme of step back, work with your tax advisors, work with your tax department, and really make sure you're understanding holistically how these credits are going to impact cash flow and tax capacity.
Okay. And then one other quick question I had, Lauren, when you were on last year, we talked a little bit about, the possibility for stacking tax credits. Are you guys seeing that in practice now that the IRA is in effect?
Yeah, we're seeing quite a few 40% ITC, 50% ITC, 110% PTC. Again, domestic content hasn't proven to be as easy to qualify for as one would have hoped, but the energy community guidance was extremely clear and makes projects kind of go or no go. So it's easy to feel confident in your energy community bonus credit. So we're seeing lots of stacking around that. The other area we're seeing stacking again is RNG, where we're seeing folks take the biogas ITC and then the 45Z PTC when that becomes available. And taking both of those credits, again, makes those projects just, look really attractive.
Okay. And as I mentioned earlier, we're having this conversation, I guess, a little more than a year after the passage of the IRA. We'll call it 13 months. So looking back on the last year, what were your biggest takeaways or any big surprises that you saw kind of surface after that legislation was passed?
Does the IRA itself count?
The actual passage of it, getting the deal done.
I mean, we had spent so much time hedging, will they, won't they, and it all but given up hope. And, we had folks here that had sat with Manchin and tried to figure out kind of where. So the passage of the legislation itself and how broadly sweeping it was, and how much it seemed to understand where the pinch point lies, in and of itself was surprising. So though I joke, I mean it seriously as well. Other surprises, I actually think the corporates have done a good job of getting involved early. It hasn't been uniform, but Lauren, I know that a couple of deals that you and I work on, we had a corporate come in through another partner and look at transferability, and they've rolled off 3 deals, in 4 months. So some of these folks are fleeter of foot than we might have thought.
I completely agree. One of my biggest surprises is just how much work there's been. Like we knew this was going to be big. We knew there was going to be a lot of deals. I don't think I could have predicted this many. I mean, it feels like every day there's a new term sheet or a new client that wants to engage with us. And so it keeps us busy. It keeps us, nimble as practitioners, but it's remarkable the amount of work and the amount of different types of work that we are seeing. again, I knew it was going to be big. I don't think I knew it was going to be this big. On the flip side, the area where I had thought it would be bigger, but seems like it has been slowed down, Michael mentioned, was just the domestic content rules and that bonus. I think folks have been incredibly frustrated with the guidance that came out a few months ago. And that's really slowed things down and made it hard to finance those domestic content bonus projects. That's an area I really hope gets corrected and that we see some interim guidance or better final guidance. But it's such a tough area, and I don't blame Treasurer of the IRS for not putting out perfect guidance, because it really was an impossible ask. In order to put out that domestic content guidance, you really have to have a fundamental understanding of how every single project that's eligible for these credits works. And that's just, a really hard ask. It's something that's probably going to take years to kind of perfect and get right. So I guess I shouldn't have been surprised, but I am surprised that was such a tough process and continues to be.
Yeah, my other surprise just coming out of the legislation, it's not how it's evolved, but the miss beyond transmission, if there was a miss in the IRA, it was sustainable aviation fuel, just in terms of the timeline that you can qualify for the credit, lapsing in 2025, and the effort it would take to build at scale these facilities. So, not a surprise per se in how it's evolved over the last year, but a little bit frustrating in terms of a untapped opportunity.
Yeah, we've been talking to a few folks about SAF, and same thing. It's kind of a longer horizon on getting that ready. So yeah, definitely a miss, like you said, as well as transmission. So for the last part of this show, Mike, you might not know this, but one of the things I ask all my guests for is bold predictions, right? And Lauren has been on the show before, and for listeners, I encourage you to go back and listen to her previous appearance, because I'm pretty sure her batting average on her bold predictions was pretty good. So what are your bold predictions about both the IRA and just the broader renewable space in the next 3 to 5 years?
Mine is that the earmark on what it will cost the government is way off, and I don't know how bold that actually is. That the program is largely going to be utilized beyond what the budgetary folks expected in terms of how many dollars will flow out or not flow in. And I admit I'm cheating because I don't think it's terribly bold. We saw this with the catch grant program, and what it will lead to is additional scrutiny. So as much as there's a lot of opportunity and there is a lot to be thankful for in terms of what was in the IRA, I do expect that we will start to see the other shoe drop on audits in the next year or so in terms of some of these structures and transactions coming under scrutiny for value of step ups, eligibility of credits, and the like. And that shoe will fall within the next year.
Yeah, unfortunately, I think you might be right. I will say because I did go back and listen to what my bold prediction was last year to see how right or wrong I was. And one thing I was wrong about was the idea that you might be able to take advantage of these credits or buy these credits as an individual. I was wrong on that. The regulations tell you cannot. Much to my disappointment, would have loved to go out and buy some ITCs and put my money where my mouth is, but alas, based off of the current rules, that is not the case. And then going forward, my bold prediction is just, more is more. There's going to be more deals. I will not be surprised this time next year when I tell you my deal flow has increased even more. Very excited about it. I think we'll continue to see this tax credit marketplace develop, even though individuals cannot buy credits. I do think we'll see more corporates get involved, large corporates, small corporates, all of the above. And I think that we might start to see some creative structuring that allows more tax exempts and municipalities getting involved and doing creative direct pay structures. That's an area where I thought I would spend a little bit more time on over the past year, and it hasn't happened yet. So I'd love to see that happen over the next year and find ways for tax exempt municipalities, universities really to benefit from these credits and be able to take direct pay on them. So that's my hope and my prediction.
All right. Well, hey, listen, Lauren, Mike, it's been great talking to you. I always appreciate the insights I get from the team at Vincent & Elkins. So I appreciate your time.
Yeah, thanks. It's been great. And let's talk again in a year.
Thanks for having us, Sean. We appreciate it.
That's our show for today. But before we get out of here, I want to say one final thank you to the exclusive sponsor of today's episode, ExxonMobil. Thank you all for listening. And if you haven't already, please subscribe or follow this show on Apple, Spotify, Google, or wherever you listen to your podcasts. And as always, please be sure to share it with your friends and colleagues. Have a great day.